This is me over here in 1999. I'm a 31-year-old aspiring day trader, armed with big dreams and a pocket full of clueless optimism. But hey, why wouldn't I be? Because this is the start of the online trading revolution, and we are right in the midst of the dot-com bubble, and money is flowing like a raging river, and I want my piece of the pie. I am ready to make $1 million as a trader. But instead of banking, I went bankrupt because I could not stop myself from chasing holy grail strategies, using worthless indicators and theories, and blindly following gurus like a helpless sheep. And that would cost me everything. Because over the next 6 years, the price of that ignorance would leave me financially drained, emotionally battered, beaten down, bruised, and destroyed like a washed-up prize fighter who owes back taxes. Luckily for me, though, my outright determination to become successful and my stubbornness to simply outlive my misery would help me turn things around. And since 2006, I have been fortunate enough to make a living as a professional trader. And what I'd like to do today is come full circle. I'd like to pay forward the most important lessons that I learned that helped me transition from a struggling amateur into a consistent professional. I want to share with you the exact strategies, theories, assets, and resources that I would use right now if I had to start all over again from scratch with nothing. That way you never have to endure any unnecessary struggling. You do not have to learn this business the hard way. You can start becoming successful right now. So my friends, as I had mentioned there in the introduction, today's video is going to be about if I had to start this thing all over again from scratch with no money, what would be the core principles that I would learn? The necessary principles to help me build the right foundation to create a 6, 7, or 8-figure trading business. So if I had a DeLorean time machine, went back to 1999, saw my younger self, first thing I'd do, smack that kid upside the head. But the next thing I would do is say, please don't trade that, trade this. Please don't use that indicator. Please don't trade that strategy. I want you to trade this. Please don't look at the market like that. Please do this right now before you go broke. That's what we're going to talk about. And it's not just for any of you who are beginning traders and trying to get into the business. This is also a video for a lot of you that might just be the hamster on the wheel, which I was stuck in for a long time. I had strategies, I had indicator, I had trading experience and knowledge, but I wasn't making any money. And on the screen, these are the topics that we're going to discuss. We're going to talk about mindset, and we're not going to have a psychological discussion here. When we're talking about mindset, I want you to understand what it means to be a trader. We're not investors. Right? So if you think about it, most social media, financial media is catered towards information for investors. Most hedge funds are investing, we're trading. And there's a big difference because we don't need to know who the CEO is. We don't need to know what the company does. We don't need to sit around and read financial statements all night long. That's not important for us to make money. Now, you can do it if you want, but you don't have to. Something else we're going to talk about is what we call the flow. Usually when we begin trading, we learn a strategy or a theory and we start shoving that thing in every market. But you're going to learn before this video is over that no matter what that strategy is, if you're in a bull market, a bear market, a sideways market, the way we attack those markets, they all need to be treated differently in order to maximize that pattern. Otherwise, you're trading noise. And it's not going to work for you long term. Speaking of strategies, I'm going to discuss with you what I think is a great strategy or a way to look at the market for everyone, including the indicators you should use and how you should properly handle yourself when it comes to risk. We'll spend a little bit of time talking about assets and assets to trade based off of your account size. Remember, we all have a different starting point. Some people are nicely funded and they have $40, $50, $100,000 to start with. Some people have $500 or even less. So your account size has a lot to do with the types of assets that you trade, and that's where you want to start out because it's going to give you the best chance to be successful. And at the end, I'm going to share with you a special tip, something that supersedes all of this. Like if I would really sit down with that younger version of myself and have a man-to-man talk, like a trader-to-trader talk, look them right in the eyes, I'm going to share that with you because I think that's more important than anything. So let's begin by talking about mindset. So for the topic of mindset, rather than go into a lengthy discussion, I just want to give you some bullet points. I want you to stop doing. Sometimes the best way to achieve something is to stop doing stupid stuff that creates barriers for you. And what I want you to do first is to stop trying to make sense of the market. This literally will drive all of you crazy, keep you up at night, and make you want to scream. The market is a cesspool of speculation. You have millions of traders around the world throwing millions of dollars around on a million different theories, ideas, and all kinds of silly stuff. There is an element of randomness that never makes sense with a market. And if you've been around any length of time, you know this. Sometimes the employment report comes out, it's terrible, stock market rallies. Sometimes it's great, stock market tanks. Sometimes earnings for a company are outstanding and they beat quarter after quarter, but everyone sells off the stock. Then there's bankrupt, broke companies with some fly-by-night product, it seems, and they're just ripping and ripping hundreds and thousands of percent. It doesn't make sense. We need to keep our minds as clear as possible, and we need to focus on just the things that's going to make us money. The rest of that is noise. Again, I mentioned earlier, financial media, social media, a lot of that stuff's narrative is pressed towards investors, not traders. I want you to stop complicating the process. If you are subscribing to any theory, studying any theory, and it takes you longer than 2 days, I'm not kidding, 2 days to figure out that theory ain't for you. If it takes more than 2 to 3 different types of data points, and 3 is being generous, if you have to trade something that needs 3 signals or 2 signals even, it's the wrong strategy. That strategy might work again for investing for a longer time horizon, but with the speed of the market, where execution is everything, you do not have time to piss around with too much nonsense that doesn't pertain to you making money. I also want you to stop trying to predict a market. Stop predicting where the top is in. Are we in a bubble? I don't know. Are we in a market crash? I don't know. Is this the top? Is this the bottom? I don't know. Try to align yourself with the market. So the strategy that you're using should align you with the market. It isn't up to us, right? So if you think about it, our opinions, you and me, the retail traders, they're worthless. The social media trader, totally worthless. Totally worthless. You can have somebody be the biggest. What are we going to do? What moves the markets is institutional money, hedge funds, institutions. We're just like little fish. Actually, we're like amoebas on the bottom of the ocean floor, sucking on the bacteria. We are not going to move a market if we combined all of our money together. It's impossible. So we have to figure out with our technicals, who are these players? Are they serious? And are they going to keep buying? And I'm going to show you how to do that. And remember, the last thing I want everybody to know, this is all about you. Don't gauge your success based on someone else's success. Don't gauge the time it takes you to get from point A to B to become successful. Sometimes people will make it in 6 months. Sometimes people will take a year. Sometimes it'll take 3. For me, it took 6. It shouldn't take you that long. The world's different. It's important because I want you guys to hear that. It's all about you. It's about you taking the time that you need. We all learn differently, right? You need to take the time that you have to learn. And we all have different things that are over top of us. Some of you have a job, so you can't give all the time you have to trading. Some people have some money and they're retired. Everybody's situation is different. I just always want you to focus on the big goal. It doesn't matter how long it takes to become a successful trader. It's a lifetime gig once you get it right. So did it suck for me taking 6 years? Yeah, I wish I would have took 6 minutes, but it didn't. It took me 6 years and it was painful and it hurt and I felt like it was forever. But it's been 20 years. I've had a job in the markets. So that's no different than an attorney or some other degree somebody would go to school for and spend 6 to 8 years studying to have a 20 to 30 year career, something they can last forever. And that's what we're after. So that right there would just be basic mindset theory thinking, how you're approaching the market. There's a lot of other things we all have to work on, but that'll at least get you started. Now, getting down to actually making trades and making money. The first and foremost thing that I think everybody needs to learn, I don't care what strategy you're using, it ain't never going to work for you if you don't understand the flow, also known as the market cycle. There are 3 cycles that every single day of the week for the rest of your life, the market you're trading, the asset you're trading is going to currently be in that cycle, an accumulation cycle, distribution cycle, or sideways cycle. Now, I'm sure a lot of you know this. This is sort of trading 101. But if you don't understand it or you fail to grasp it, sometimes we understand it. And then, of course, when we start pushing buttons, we somehow forgot all the lessons we learned. I mean, that's an entirely different problem, but I suffered that too. And sometimes, the basics are exactly what we need. And I want to show you that because, as I said earlier, the way you attack a bull market, a bear market, a sideways market are entirely different. And don't be naive enough to think that whatever you're looking at won't be bearish and that whatever you're looking at that's bearish won't become bullish, because it will. And there's also a theory I'll share with you right now that if you think of it this way, money doesn't leave the market. So when I go back to the investor talk, money doesn't leave a market. It cycles the wagon. There's this old saying that you sell your winners and buy your losers. So in theory, which is relatively accurate, whatever is hot today, whatever you're seeing on the top of your screen, that's the talk of the town today, it's going to be in the doghouse tomorrow. That doesn't mean market crash, but the market's not going to want it. And whatever's in the doghouse right now, they're going to want it. And let me show you what I'm actually talking about right here on screen. You're seeing this right now. So doing this video, the talk of the town, the heat of the heat, this will answer a lot of questions. Let's talk about Tesla, one of the most emotional stocks. There is a reality and then there's a fantasy. There's going to be a lot of traders that are buying this for the long term, putting lofty projections on price targets, coming up with all of these equations. Great, you can make money. But as a trader, that's not important. The only thing that's important about this is that you are in one mass accumulation cycle. Another tip, is it overbought? Well, I guess if you threw an RSI up there, sure. But overbought often becomes more overbought. Oversold often becomes more oversold. Don't bother with that. It's going up. Who cares what the reason is? This is accumulation. So is this the top? Doesn't do you no good. You're going to have to use other tools to figure that out. Time will tell. But I'll say this. One day there will be a top. One day they will not want this. One day it will sell. That doesn't mean bearish. That doesn't mean the long-term investors in 5 years from now, it won't be tripled, quadruple, or whatever the price is. Trader. There's a big difference, right? Trading. And that's what we need to approach. Now, I'll show you what I mean by that as well. Because if you look at this right now, here is NVIDIA. So NVIDIA is probably one of the best stocks over the last decade, up thousands of percent. If you have any kind of market knowledge, you've heard of this thing before. It's insane. So take a look at this. Just want to show you simple market cycles and how money cycles the wagon. So in January, everybody wants AI. They're just romping. We get up here to, just right into November, and all of a sudden, while this market's just bamming out all-time high after all-time high, NVIDIA's going down. Does that mean NVIDIA's a terrible company? Does that mean that we should be worried? No, it's just a distribution cycle. So Tesla is in an accumulation cycle, NVIDIA in a distribution cycle. So if you look back at Tesla, take this spot right here where kind of NVIDIA topped out in November, you'll see, well, that's about the exact same time that Tesla went on a tear. So are hedge funds and institutions dumping NVIDIA positions to get on all the hype with Tesla? Probably. That makes sense. It doesn't matter. You can see the differences. Now, here's where this helps you. If you want to buy the dip on NVIDIA, right? If you're an investor, this is a great dip to buy. They're a great company. They make tons of money. They got a bright future, the king of all AI spaces. It's a discount. But for a trader, it's not a discount. It's not a discount because you are breaking down certain levels on a daily chart. You are constantly selling against a market that is like historically nasty bullish, like nutty bullish, like mass euphoria. And then all of a sudden, nobody wants this, right? I hope that kind of makes sense to you. So if you're a dip buyer, have a strategy of buying dips and flags and breakouts and momentum, NVIDIA is not your game. you're not going to get the money you want. It would be better for you to go into the quote unquote overbought Tesla right now and try that strategy versus Nvidia, right? And everything goes through this cycle. So as you watch this, you'll see the date on the video. Months from now, who knows how long? Will they role reversal? Will everybody find a reason? And speaking of news, when I said don't worry about things, sorry if I'm ranting a little bit, but the market will create the news it needs. It will create the narrative that it needs to sell something. One day something will come by with Tesla. It'll sound so stupid and it'll get smoked. It's just a game. So you can see that. And if I just kind of pull up the SPY here, you'll see the same thing. The S&P 500, I'll back it out a little bit. It has gone through the same type of cycle. We began the year with a very strong accumulation cycle. So things like buying dips, breakouts, momentum trades, they're going to work. Short sells, they're going to be tough. It doesn't matter if it lasts or it doesn't last. It's that moment in time. You have to go into that market, if you're a long buyer, a momentum buyer, with aggression, because it's going to stop. And you'll see it does. You hit around April, May, you get a correction. Now, there was news on this correction. It was Iran, Israel, which is very unfortunate. But it was more of an excuse to the market because the market already knew it was coming. It just provided the platform or the nudge to get the market selling. A few weeks later, they're back to buying. And look, they'll ramp this up over and over again. And you'll see every single one of them if you actually just block in the rallies, right? Just like this. We're going to block in the rally. And you'll see it go on these multi-month extensions, right? You'll see that all of those are separated by a correction, right? So there needs to be a correction to ignite a rally. And at some point, the rally just gets too high for everyone and it goes through a correction. So you have to figure out when you have a strategy what you're doing. Again, let's talk about two different types to speed along. So if you're dip buyers or you're rip sellers, you're selling rips, you're a short seller, short strategies, right? Anything can work, right? So in a dip buyers market, bull market, you want to be aggressive here. You want to hit your position sizes hard. You want to hold your targets longer. You want to loosen up your risk because the market's helping you. Who cares why it's helping? It's helping you. Run with it because it's going to end one day. And that's it. Now that strategy is not going to work the same here. In a down cycle, if this is your dip buying process, you're going to have to be more selective. You're going to have to take a little bit longer time to make your decisions. You have to tighten up your risk, trade with smaller sizes. You can still use the same strategy, but you need to dial it down. Hopefully that makes sense. Inverse relationship. If you're a seller, well, you got to pick your spots, use your risk wisely on these markets and take advantage of impulses that happen intraday. You can hammer on in these sell down spots and you just keep taking your strategy and working it into the market. But hopefully you'll see there's a lot more to market cycles than that. But in bull markets, when people get euphoric like now, the buying can go on for months on end and months on end. And the same thing with selling. It can last forever. What we can't do is make tons of money in a bull market and give it all back in a 3-day bear market or a sell-off. It doesn't even have to be a bear market, just a correction, wiping people out. And that's something that we can't do. So on that note, let's talk a little bit about strategies. Now, I'll share with you what I normally do on a day-to-day basis in the market. But what I'm really going to show you, or what I want to start with, is a way that you can take whatever you're using now and eliminate the BS and get down to business and start making money right away with it. I'm going to show you how to revolutionize whatever strategy you have by executing a whole lot better. And in this section, we're going to talk about price action. I'm sure most of you heard this, which is technical analysis. The reason we're using technical analysis and why, in my opinion, is because all known relevant information about a company, remember we're traders, all relevant information, how much money they make, their prospects, the way the market thinks and feels about them is in that chart. So it can't be overbought if the market wants it to be overbought. It can't be oversold if the market wants to be oversold. They're buying it for a reason. They're selling it for a reason, right? We find those things through technical analysis. I want you, if you're not successful, to remove every single indicator, line, drawing, everything. And trust me on this. Now, if you've got something that's working for you pretty good and you need a little indicator to push you over, do it. But in the beginning, I highly suggest you do not put that stuff in your head, because an indicator will not make you successful. You have to have a process and an understanding of support and resistance first. Otherwise, every indicator you use, it's not going to work. An indicator can only take a good strategy and make it a little bit better. It can't solve your problems, and I think most of you know that. And in the beginning, I just want you to keep your mind as clear as possible. That's what I would tell myself. Don't complicate yourself with lengthy processes and lines and drawings and alerts. Just focus on the price action. And the best way to do that is something I'll share with you. I've done a video here on YouTube with it. It's called the box theory. It's like the caveman's way. Dumbed it down for myself to figure out. I'm going to show you what you should be looking at every day. Talk a little bit about time of day and the risks that you should take on a trade. So, for example, let's just pull up the S&P 500 here, the SPY ETF on the screen. And we're going to start out with a daily chart. Now, you will see, like I mentioned there a little bit ago, you saw it. Well, we've been in an uptrend all year. So anybody like over the age of 3 can figure that out. The key is, well, we're in an accumulation cycle. We're in an upward momentum cycle. But how do I trade that to the best of my ability? And usually what traders tend to do is just start diving in and chasing green candles. We definitely don't want to do that. And this is where the box theory comes in. Now, I use 5-minute charts, which is just a preference. It works on 1 minute, 5 minutes, 1 hour, 15, and I'll show you different variations. But here would be the 5-minute chart spanned over a couple of days, and you'll see something I want to draw your attention to is the ebb and flow. Notice that it goes up and then it goes down. It goes up and then it goes down. It goes up and then it goes down. So even the most bullish, radical instruments, there's pullbacks, right? And the key to this is every pullback tells a story. For some of you that trade a flag, that's the premise of the flag, is that you get a very bold, strong, bullish run, a tiny, tiny pullback. So it's common sense. A tiny, tiny pullback after a big run means no one's selling. So if you're a short seller and you want people to sell, they're not selling. Are they stupid? Are they going to pay for it? Maybe, but they're not selling right now. Trade ain't going to work. It's most likely a buy. Same thing. Favorite stock in the world's taking a dive. It ain't bouncing. Nobody wants it, right? You got to get out of it, right? The market will tell you whenever it's ready. Hopefully that makes sense. But here's the box theory. You'll see on the screen, this is Think or Swim. Let me open this up just a little larger so we all can see properly. Right? This is the previous day's high and previous day's low. The black area is where the market is officially open and the pre-market is the gray. I use all data that I have, pre-market and post-market and regular market. So you simply can go to, let's go back to this day right here. And you can start with the pre-market high with this high that's connected from the previous day. Old saying, look left to get all your answers, right? You just mark the top and you can mark any pivot bottom. Look at the bottom. You got a bottom here, you got a bottom here. But let's take the lower bottom right here. That was in the post market. So this was the trade, not to trade from yesterday, but the action from yesterday. And what I do is I box that in, okay? And as a base theory, which I mentioned in the box theory video, it's not ironclad. It's not etched in stone. It's not, please don't take technical analysis literally. It's a guide. But for the newbies, try this. As you reach the top of this box in terms of price, try not to be the big time buyer, okay? Same inverse relationship on the bottom. Try not to be a seller down here. So if you're a buyer, breakout buyer, don't start it up here. And if you're a short seller, please don't start shorting down there. That's like the worst thing you can do in the world. And the old rule of don't diddle in the middle. There's a lot of noise and hard reads in the middle. So here's what I'm saying. Let's go back to just using the typical basic 101 flag pattern. If I trade a flag pattern here versus here versus here, I'm going to get 3 different results. One of those are going to have a higher degree of probability, which is always what we're trading, probabilities, of working. And that's where I want to use it. I don't want to use it up here. And you'll see if I block that area out, let me get the right here. And I'm going to carry this all the way to where we are now, right? And you will see that over the last few days, prices have consistently rejected this area. I don't make the rules. Remember that. Take your personal feelings out. What does this mean, guys? It means there is a seller, a significant seller up there. It could be a whale, an institution, a combination of retail traders, an imaginary celestial substance forcing the market lower. Who cares? Somebody's selling there. Common sense 101. I ask you now, you know there's a seller up there. Why would you buy? You are not strong enough. I ain't strong enough. We ain't got that much money to bully whoever that is. They're way bigger than us. That's what you're using technicals for. So rule number 1 for everybody, you love it, you want it, you got to have it, you want to buy it, don't do it there. You're going to be in trouble. Now, at some point, it will move through that box, create another box. It will go to another level or trade to another level. Then you may want to look at buying it, right? But until then, you're trapped, right? And the trade has to be treated differently. And you'll see it hasn't stayed down below for very long either. And as I'm doing, it's very close to the close of business right here. We've been selling off all day, but it's not a short here either because a big buyer normally has shown up in this area. So there's a battle going on between the top of that range and the bottom of that range. So many of the things that we do trade are in those sideways distribution channels. And if you see on the daily, it actually matches that same pattern. So you're up here, you're sideways for many, many days. So sideways trading is simple. You want to, that's where the box theory really excels, because if you just blindly bought at the base of this and sold towards the top of this, I mean, that's super hypothetical. It's not the easiest thing in the world to do. Don't get me wrong. It's working, right? And that's what you want to try to focus on, getting long into those. Now, you newer traders, these fancy concepts they come up with, they call that liquidity. Call it what you want, right? It's support. I don't mean to bash anything. Liquidity, there's a big buyer there. It's easy. In the middle, we don't know that. Now, some people would ask me, why don't we trade in the middle? Why wouldn't you do that? You see some charts where, yeah, that works. Why wouldn't you do that? Because it doesn't work over time. And that's what's going to hurt you. And I'll show you why. Because it's all about risk. So let's say I am a buyer of this instrument in the middle of this chart. Let's say anywhere, right here. Right? I'm a buyer here on this day, inside of this box, in the middle. Well, one thing that traders make a lot of mistakes on is stop losses, right? Risk. Like, well, what would be the risk? If you use a technical setup to get in, you got to use a technical setup to go out. My theory is simple. I want to position, my risk is the low of the day. That's my risk, is the big buyer. I want to be under the big buyer. They're my guardian angel. So that's at least down here, right? Makes perfect sense. Well, if the big seller keeps it suppressed for the whole day, again, I'm talking about day trading, right? Trading. We might not get up above here. So if I draw a profit window from the middle to the top, or from there to there, they're the exact same size. It's a basic one-to-one risk versus reward. It doesn't mean it won't work. And maybe in really secular, strong bull markets, you need to kind of pinch up. Maybe they don't give you those pullbacks. You have to adjust. That's okay. We can do that. But in sideways markets, you don't want to do that. Bear markets, you definitely don't want to do that. It doesn't balance risk. And if you think about where your risk is first, if you think about where you stop, where would I stop? That's where your entry should be. So actually, I say, I will stop down here. That's where your buy should be, right? If you were a short seller, my stop would be up here. Well, that's exactly where I would want to initiate the short. If I'm a buyer, my buy would want to be down here. I want to buy, right? Hopefully that makes sense. And the thing is, we got to be on the right side, not just to mitigate risk, but to maximize our reward, because when the trade wins and it extends out of the box, you will make a lot of money, or you should make a lot of money. Now, starting with this, I typically will do something like the high and low of the previous day. So giving you a trade of how I would approach a market. I always start with the previous day's high and low. So this would be the S&P 500 SPY, whether you're trading the futures, it doesn't make a difference. Let's put the futures up there. A lot of you like those futures. We do the ES. And you got a contract change, but it's the same thing. Let's just block the top, box the whole day in, right? And now that you've seen this day, I want you to see what's happened. Take a look at what's happened. It did the same thing back here. I want to draw a box back here. Look at how many times this thing flirted with the tops and bottoms. Now this gap up, for those that don't know futures, we rolled over to a contract. There's a small gap in these futures. It's not the same thing as the S&P 500, but you see this more often than not. So you'll see today, right? You stayed in those ranges. And if you look at everything, all of these rallies begin with these ranges. So take a look. You went to the top, you created a range, you came back in there early today, and that's where you've stayed. Just like this, you were testing the top of the range, the bottom of the range, top of the range, and bottom of the range. Again, the point is clear. The basics. Don't jam yourself in the center of the chart. Try to do your buying towards the bottom. And if you really need more knowledge, which I'm sure you do, these videos sometimes go quickly, but I want you to take any chart you've got, and we'll back this thing out. And I want you to just look at the thing without indicators, right? Back to cycles. Notice again that every single rally has to begin with a sell-off. There's an ebb and flow. There's like, if you were to draw this in a line, it's like that. Play that. Seriously. It's that simple. Play that. Stop it with the other nonsense. Just play that, right? Play that ebb and flow. Play that rhythm. That's where the money is. And every single thing. Let's go back to Tesla. Nutty. Look at Tesla. Nutty, nutty, nutty. It's like, oh, it goes up every day. Oh, it goes up every day. People FOMOing. Yeah, but there's a pullback every day. Take a look at what's happening. There's also little nuances in here. Take a look. You begin the day. You test the base of the range. You tested the base of the box, rallied, and then sold off, right? There's your new box, right? Taking this high, this low, and connecting them through the next day. What happens? Right out of the gate, you test, you pull back, then you break, right? So on those first passes, we don't want to buy at those highs. It's the worst place to buy. Again, you might get away with one like this because it's super ridiculously bullish. But if you do 20 of these on 20 different instruments, you're not even going to make it that far. And look, it moves back up. Next day, right here from post-market to pre-market, before you opened and before you got here, you tell me what happened. Before you got there, it sold off the morning spike, which was precisely at the top of the range. Come on. Tested the bottom of the range, then shot up. This was a strategy I used called the check mark, where I look for bull stocks, strong stocks, and this is exactly what I buy, is the pullback in the morning. I look for, and it's not a breakout retest. Breakout retests don't pull that. It's an absolute destruction, which sucks in the bears, and then you check mark. Trade looks like that. Check mark, right? And a check mark before that, right? And that, they're not necessarily perfect all the time, but what I want you to do to keep the basics down, just take this chart in your own time and look at it. I want you to stare at it every single day. I want you to watch it every single day of the week. The more you watch, the more you'll pick up on it. The more your eye will get trained. It pulls back into the base of the range before it runs up. So what happens here, to give you the last point, here would be your box for today, right? If you just drew it through pre-market, it hasn't done much in and out of that, right? So you started up high. Again, you can't be the buyer, right? Right there, because you immediately bought and ended up all the way down here. Now, of course, somebody will always say, well, you would have made some money. Really? Like, that's a lot of money to give up. You probably would have been stopped out. And again, back to the point, if trader A buys here, trader B buys at the base, they're both long, They both want the same thing, but Trader B's got money right now. Trader A's break even and has a decision to make. The market's going to close, and do you hold it? Also, that's the risk. You're going to buy things like this and give up this much risk. You're talking about $22 worth of a stop loss. You're insane. You have to make $22, and you can see it's just stopping there high day. Again, that probably makes sense. But the best way to look at price action is to decode what the market is saying to you when you make the trade. The box theory helps you. So in the bottoms, it should get up there. Like here, it did make another rally up towards the top of that box, right? It got up into there, and then it retested bottom. Actually went a little bit lower that time. So again, hypothetical, super hypothetical, definitely hindsight. But look, shorting there, covering, buying, selling. Again, it's super hypothetical, I know, but accurate as hell. And that's it. Like, again, third grade, you learn how to draw a box. It isn't that difficult. And that, I mean, you can make $1 million off of a freaking box. You don't need all of those fancy acronyms, long drawn out theories. I want you to think of this, and I'm sorry if I'm ranting, guys. It's buyer versus seller. The stock market is no different than like a supermarket. You go in there, milk, it's cheap. You buy all the milk you want because it's cheap. One day you walk in there and it's like $8 a gallon. I don't think milk has ever been there. You stop buying milk. I don't want no more milk. You don't want more milk. That's trading. The market will run it up as high as it needs to get people not liking it no more, drive it as low as it needs to, make people want to buy it. It's a simple process. You don't need the rest of those theories. So let's kind of move on. So I want to take a moment here in this section and talk a little bit about accounts and the types of assets that you should trade based off of your account size. And before I get started with the whole thing, guys, this is just a recommendation. Over my 25 years of trading, I feel that these are probably, and I say probably in air quotes, the best direction for most of you to go. Look, there's no rules in trading. I'm not here to tell you one strategy is better than another. One asset is better to trade than another. I'm simply providing you with some recommendations and a starting point. If you have something that's working for you, an asset that you like to trade, don't listen to me. Just don't listen to me. Stay with it. We can do anything from cryptocurrencies to option contracts to foreign currencies. I'm mainly talking about stocks here, but those are on the table too as well. I just want you to know, trade whatever you are comfortable with and don't listen to anyone else. You can take the theories that we discussed and use them. But for those that struggle a little bit, or maybe it's not working for you, here's just some recommendations or a few suggestions that I have. Take them for what they're worth. If your account size is over 25,000, you're not affected by the pattern day trading rule. Don't have time to get into that. I'm sure some of you and most of you have heard about that. You can Google PDT or pattern day trading rule. It will tell you about that. But if you have an account over 25,000, that's a good starting point for a day trader. And I would say sticking with most likely Beta, which is the Mag 7, Tesla, Google, Netflix, Amazon, Microsoft. You can also Google them. Or the Mag 7 ETFs, which I'll show you. The micro futures would also be a good place to start. So, for example, each one of these ETFs, not these ETFs, excuse me, something like Tesla. You have Tesla here, obviously for some, it's a $400 stock. So if your account is small, it doesn't pay you much to trade this stock. You don't have enough position size to lean into that, but you do have something like TSL, T-S-L-L, sorry, I like to pronounce things, which is same thing. It's a Tesla ETF for 40. You have things like MSFU, right? MSFU, which is like a Microsoft, right? You see, it's the same move, but it's $40. Where you can buy Apple for like $30, Microsoft for like $40, Tesla for $20 or $30. You can go to Pro Shares or Direction Shares, and you can look at bull ETFs based off of Mag 7, and you can also trade them. I wouldn't recommend investing in these, but these are great tools for those who want to trade and you want to expose yourself without having to trade the high price of Tesla. I also feel, in my personal opinion, which is mine only, they are better than trying to get tangled up with zero date options. I think there's a lot more, not that zero date options don't work or short-term options don't work, but I think there's another level of knowledge that exceeds what this video is providing for you that you need to learn in order to trade that. And always remember that too. Understand fully what it is you're trading first before you get tangled up with it. Okay. So again, options are something that's a little bit more complex. Same thing here with micro futures or futures in general. You don't need the PDT if you're going to trade things like the E-mini, and you have micro E-minis, the MES, the micro Qs, for example, you have MES, micro Qs, same thing. You can buy the market via a futures contract. They can be volatile at times, and there's a lot of algorithmic participation in here, which has, again, something you need to educate yourself on. The more kind of algos and institutional flow you have, the more shenanigans get played in these. But for newer traders, just if you call it the dumb guide to trying not to blow up, there couldn't be, in my personal opinion, anything better than to buy dips on the S&P 500. It's one of the only, like the markets themselves. That's the only trade ever in history that's worked 100% of the time is dip buys on the market. The market does always go up. It is engineered to always go higher. It has certain things baked into it that stocks don't, such as limit downs, limit ups. You have halts. You have all things to protect that thing from getting totally out of control. It doesn't mean you can't lose money on it if you're silly, but there are other things that are involved. So, for example, if Tesla drops 30 or 40%, no one cares except for people holding Tesla. The Fed's not going to do anything. The market drops 6, 7, 10%, 15% in a day. The Fed's going to step in and make some emergency rules or something to stop the bleeding. They've done that since I remember. And that's an edge. That's an edge that can be repeated and an edge that can be used. So those are also good to use. And I would say for those that below that, the futures and micro caps would be, in my opinion, the better instruments to trade because you can get the leverage you need on a smaller account. And even those over 25,000, trading the futures is a great way to get familiar with an instrument, to have some safety, and to learn how to trade. Now, there's a lot of shenanigans. Now, when we come to things like micro caps, some people call them penny stocks. To me, these have provided some of the greatest gains possible because you have a chance to buy something that simply an Apple and a Tesla can't do, like this Nook here. This thing goes from $2 to 16 today, right? So I don't know how many percent that is. What do I got? 754%. The market's not going to go up 754%. Apple, Google, Netflix, Nvidia, they're not going to go up 754% in a day. These things offer to me, and the most millionaires that I've seen in trading over 25 years, kind of all of us cut our teeth on penny stocks. Now, there's two ways to go about this penny stock ordeal that I want you to understand. There's a great edge in short selling these penny stocks. And what I want to know is I want to back up. Remember, rule number one, know what you're trading. If you're going to walk into if you're going to trade futures, go into futures understanding the shenanigans that get played. But there's a positive and negative. There's a lot of shenanigans. There's a lot of algorithm influence. You have to be fast and you get a lot of fake outs, but there's safety there. You go to penny stocks, there's a definitive edge. They're very simple to read, but you have to know that you are buying or even short selling a total scam, right? So these companies don't make money. 99% of them are a total joke. It's just some sort of manufactured pump and dump scheme in most cases. But the first day or two, they offer a lot to run. You have to know that. You have to understand that edge to trade the penny stocks and the micros, that most of these things aren't worth the paper that they're written on, and it's going to dump. So you have to take the gains. But look, if you have $2,000, again, a really super hypothetical trade. It's just all hypothetical, hindsight 2020. I'm just laying it out there. You had $2,000, you bought it, you could have 16 by the end of the day. That's the power of the market. Again, that takes a lot of skill to do that. That is definitely not typical. That's super hypothetical. I'm just saying in a roundabout way, those are good. Another one here, like what do we got? OPTX. another one. So you'll get a few of these a day. Now there's a good angle too to short sell these, but I would recommend be very cautious about that. It's a very simple, easy strategy to use. It's one that works a lot, but it's one that requires a different level of risk management because it doesn't, every once in a while, one of these comes by and really puts on the squeeze. But these are great things to get started. And I would also recommend that. I love short selling, and I think short selling is a fantastic way for traders to make money. But I would think that for new people getting started, stay off of that right now. Try to focus on longs only. Even in bear markets, you're going to find a lot of bounces. It takes a little bit of working to get that short correct. It's a great strategy, probably one of the best, but that's a whole nother topic. Just giving you some straight up advice. And also for those that are really sub $10,000 in balance, probably your better choice is to go with these prop firms. Now, some of you may have 25,000 in a prop firm. You may be looking at prop firms like a Top Step, Apex, and so on. These are great places for people to start that don't have a lot of money. And it's a great place to learn how to trade. You can expose yourself to trading futures for maybe $40 a month, $100 a month, or whatever their fees are. Again, know what you're getting into. Do your research with those because all of them are going to place restrictions on you. And as you develop as a trader, you want the least amount of restrictions. You want the most amount of money, the most amount of freedom to trade what you want, the widest stop losses, the huge gain. You don't want to sit around and go, well, I'm going to get my count turned off if I go past X amount of drawdown. You have to pay attention to all those things, which can be good and bad. It's great to have risk management, but when you're starting out, there's a really tight window, if that makes sense, when you're dealing with prop firms that you have to work with. Again, that's great. For some people, that's the only choice they have, and I recommend that. It's a great way to get started. Like Top Step is like $50 a month. You can start out on a simulator, and you can just practice, learn how to trade, and then eventually make enough to get a live account. That's a great way to do it. One thing I will say, though, as I've always had experiences with, simulated accounts take a lot of, it ruins everything that we do. Trading is all about emotions. And if you're robbing yourself of living through the emotions and dealing with emotions, well, you're going to have trouble. Again, brief overview of this, different ways to climb the mountain. Just educate yourself on each one of these. They all offer great opportunities to make money. Just make sure that you're fully aware what you're getting into and you know the nuances and the edge, and things will get better for you. So friends, it's time for a special tip. This I want you to write down because no matter what you do, where you go, this always applies to trading. There are three main components that define every single thing that we ever do from now until the end of the time. And that is idea, execution, management, IEM. Please write that down. Because when you get up every day, you have an idea. You have a thought to do something. But that thought is nothing if it can't be executed properly. You probably heard me say that earlier. Execution is everything for us, right? You must decide and really understand where is the right time and place for me to execute this particular idea. And more importantly, it's always about management. I never learned a single thing more about technical analysis since 2005. What got me better was better choices, the small things. I was once told, don't focus on making money. Focus on making good trades. Commit to your process. If you get up every day and you focus on the assets that meet your goal, your process, your setups, your ideas, that's where you want to be. But the big key that really turned the corner from struggling amateur to pro was management. Was I could soon realize, and you will realize with time, the faster you can realize that this trade isn't going to work and get out of it, the better off you are. Because I don't care what anybody tells you, if you span our whole body of work, the best that we can do, the best that I've seen in the world, still lose 20 to 30% of the time, no matter what. Now, sure, sometimes we can have 100% month, right? One loser the whole month, sure. But a body of work spanned for a day trader, 30%, 20% is not going to be good no matter what you do. And that's where the key to winning is. You can't let those 20 to 30% cost you the rest of it. Now, you have to take all the trades. You never know which is going to give you the gain, which is going to be the loser. You don't know that before you get in. None of us know that. But you have to be a good manager. Again, I want to go back to the box theory. By buying down towards the low with tight stops, selling towards the high with tight stops, you might lose, but you're not going to lose a lot. If you get stopped out, you've got your answer. If the person buys at high a day, goes all the way to the low a day, and then they figure out this isn't going to work, look how much you've lost. You can't take that kind of risk. You'll soon realize it isn't about your hit rate. It's about your P&L. That is what you are as a trader. It's about your profitability. And the more times you can get into the right trades, the more money you're going to make. And the less that you blow up and take huge losses, consciously or subconsciously, you'll realize that you can trust yourself. And then you'll be able to take the next step, which is sizing in. Because none of this works if you don't lean in with both hands. But you can't do that if you're reckless, if you don't trust yourself, if you have issues. You've got to be able to build that process first. So take your time. Idea, execution, management. Study it, rehearse it, think it. So guys, I'm going to call this video. I hope you enjoyed it. Probably a little bit lengthy, but I hope you got some true value out of it. If you have any comments or something I left out, which I sometimes do, probably do, go ahead and put it down in the comments section. I always want to draw attention to everyone else. We do a watch list every week, the best stocks, how to trade them, setups, videos, and everything is completely free. You go to the rumors.com. I'm going to put the I'm kind of forgetting what I'm talking about. I'm going to put the website right here on the screen. You can go visit it. I want to say thank you. If you like the video, like it, subscribe, do all that good stuff. Hope to see you here in the near future. On that note, guys, take care, trade well. Cheers.